Hello, traders, and welcome back to the channel. Today, we're diving deep into a fundamental tool that every trader, from beginner to pro, should have in their arsenal, the moving average. If you've ever looked at a price chart and felt overwhelmed by the jagged, up and down noise, then this video is for you. We're going to break down exactly what moving averages are and how you can use them to smooth out that price data, revealing the underlying trend with much greater clarity. This simple indicator can transform the way you see the market, helping you make more informed and confident decisions. So, grab a notepad, and let's get ready to demystify the charts. First things first, what exactly is a moving average? Don't let the name intimidate you. The concept is incredibly straightforward. A moving average, or MA, is a technical indicator that calculates the average price of an asset over a specific number of periods. Think of it as a way to create a single, flowing line that represents the general direction of the price, filtering out the short-term, random fluctuations. For example, a 20-period moving average calculates the average of the last 20 closing prices. As a new price point comes in, the oldest one drops off, causing the average to move along with the price. This smoothing effect is what makes the MA so powerful. It helps you see the forest for the trees, focusing your attention on the true market trend rather than getting distracted by daily volatility. Now, let us talk about the two most popular types of moving averages you lines encounter: the simple moving average, or SMA, and the exponential moving average, or EMA. The simple moving average is the most basic form. It gives equal weight to all prices in the period. If you're calculating a 50-day SMA, each of those 50 days has the exact same impact on the final average. It's clean, simple, and provides a very smooth line, which is excellent for identifying long-term trends. However, its simplicity is also its main drawback. Because it weights all data equally, it can be slow to react to new, sudden price changes. A big price move today has the same influence as the price move from 49 days ago, which might not be ideal for faster-paced trading. This is where the exponential moving average, the EMA, comes into play. The EMA is a bit more complex, but the key difference is that it gives more weight to the most recent prices. This makes it more responsive to new information and recent price action. So, in our 50-day example, a 50-day EMA will react much faster to a price spike or drop that happened yesterday than a 50-day SMA would. This sensitivity makes the EMA a favorite among short-term and swing traders who need to react quickly to shifting market momentum. The trade-off is that because it's more responsive, it can also be more susceptible to short-term noise and false signals compared to the smoother, slower SMA. Neither is inherently better. They just serve different purposes, and your choice will depend entirely on your trading style and strategy. So, how do we actually apply these to a chart to gain clarity? It's incredibly simple. On any trading platform, you can add an MA indicator to your chart. You'll then be prompted to choose the type SMA or EMA and the period length. Let's say we're looking at a daily chart of a stock. If we apply a 50-day SMA, you'll immediately see a smooth line drawn over the price candles. When the price is consistently trading above this 50-day SMA, it's a general sign that the asset is in an uptrend. Conversely, if the price is consistently below the 50-day SMA, it suggests a downtrend. The moving average line acts as a dynamic level of support or resistance. In an uptrend, you'll often see the price pull back to the moving average, bounce off it, and continue higher. This visual guide is invaluable. Instead of just seeing chaotic price bars, you now see a clear story, trend direction, and potential areas to buy or sell. Let's discuss choosing the right period length, because this is crucial. Common short-term periods are the 10, 20, and 50-period moving averages. These are great for swing traders, as they react quickly to price changes. For long-term investors, the 100 and 200-period moving averages are the gold standard. The 200-day moving average in particular, is widely watched by institutional investors as a key indicator of the long-term market trend. A market trading above its 200-day MA is generally considered to be in a healthy, long-term bull market. There's no single best period. The key is to experiment. Try different lengths on your chart and see which one best respects the price action for the asset you retrading. A good moving average period should act as a reliable guide, with price frequently reacting to it as support or resistance. Don't be afraid to test different settings until you find what works for your strategy. One of the most powerful techniques using moving averages is the moving average crossover. This strategy involves plotting two moving averages on your chart, one with a shorter period and one with a longer period. A common pairing is the 50-period MA and the 200-period MA. When the shorter-term MA crosses above the longer-term MA, it's known as a golden cross. This is a bullish signal, suggesting that momentum is shifting to the upside and a new uptrend may be starting. Conversely, when the shorter-term MA crosses below the longer-term MA, it's called a death cross. This is a bearish signal, indicating that a downtrend could be on the horizon. Crossovers provide clear, objective signals for potential entries and exits, removing a lot of the guesswork and emotion from your trading decisions. Now, it's vital to understand that moving averages are not a crystal ball. They are lagging indicators, meaning they are based on past price data. They don't predict the future. They simply show you what the trend has been. Because of this lag, they won't get you in at the absolute bottom or out at the absolute top. That's not their purpose. Their purpose is to help you capture the majority of a trend. Therefore, you should never rely on a moving average as your sole reason for making a trade. The best approach is to use them in conjunction with other forms of analysis. For example, you can use a moving average to confirm the overall trend, and then use price action patterns, candlestick analysis, or other indicators like the RSI to pinpoint your exact entry and exit points. Combining tools creates a more robust and reliable trading system. Let's walk through a practical example. Imagine we're looking at a chart that has been in a strong uptrend. We've applied a 20-period EMA. We notice the price has been staying above the 20 EMA, pulling back to touch it, and then bouncing higher. This confirms the trend is strong. Now, we're waiting for our next entry. We see the price start to pull back towards the 20 EMA again. Instead of blindly buying, we wait for confirmation. We watch for a bullish candlestick pattern, like a hammer or a bullish engulfing candle, to form right at the 20 EMA. When that pattern appears, it's our signal. The moving average told us the trend and the area of value, and the candlestick pattern gave us the timing for our entry. This multi-layered approach is how professional traders use moving averages effectively. To recap what we've covered, moving averages are powerful tools for smoothing price action and identifying the underlying trend. The SMA gives equal weight to all data and is great for long-term trends, while the EMA gives more weight to recent data, making it more responsive for shorter-term trading. You can use them to determine trend direction, identify dynamic support and resistance levels, and generate trade signals through crossovers. Remember to experiment with different period lengths to find what fits your trading style and the asset you're reanalyzing. And most importantly, always use moving averages as part of a comprehensive trading plan, not in isolation. They provide clarity, not certainty. Thank you so much for joining me today to explore the world of moving averages. I hope this has helped you understand how to use this simple yet effective tool to clean up your charts and improve your trading clarity. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And don't forget to subscribe and hit that notification bell so you don't miss our future videos where we dive into more advanced strategies. Do you have a favorite moving average setting? Let me know in the comments below. Until next time, trade smart and trade safe.